Hi. And welcome to Financial Planning with Michael Feltman. And your guide to understanding South African tax. This is an episode-based series, where I will be walking through all of the confusing elements of tax, and explaining them. In today's episode we will be discussing the tax structure in South Africa, including who pays tax, when is tax payable, how are you taxed. We will also discuss a few key terms that are used in the tax industry. So, let's dig in. Tax has frustrated people for nearly as long as civilization itself. Let's face it. There is never a suitable time to discuss tax. Margaret Mitchell once said, "Death, taxes and childbirth. There's never a convenient time for any of them." With that in mind, there is no better time than the present to start learning. So, let's start. First off, who pays tax in South Africa? Well, South Africa follows a source-based system, meaning there are two types of people who pay tax. These are namely, a resident or non-resident. An ordinary resident is someone who either refers to South Africa as their usual or main residence, their real home, or where they normally live. Where a person meets the above definition, they will deem to be a tax resident, and therefore they must pay tax on their worldwide income and not just their income made here in SA. This is subject to an exemption. A non-tax resident, on the other hand, is only taxed on what income is made here in South Africa. For example, we have Mohammed. Mohammed is a foreign national from the United Arab Emirates, and is working for Sasol over the next 6 months on one of their projects in petroleum development. Mohammed will only be taxed on what income he makes here in South Africa and nothing else. This is because his income has been sourced here in SA, and so, the state is entitled to tax Mohammed on his revenue. Now let's discuss when tax is payable. Tax is payable per year of assessment, namely for income tax from the 1st of March of one year to the 28th of February of the following year. This is different for provisional tax. Provisionally, tax is payable semi-annually. The first provisional tax payment must be made within 6 months of the start of the year of assessment. For years of assessment starting March, this will be the 31st of August. The second payment must be made no later than the last working day of the year of assessment. A company's year of assessment is simple. It is whatever date they choose when the company was incorporated. There are two ways in which the state taxes residents. The first is directly, and the second is indirectly. There are different types of direct and indirect tax. Let us start off with the types of direct tax. Firstly, income tax. Income tax is imposed on persons. Each person has an applicable tax rate that is applied to taxable income, with the exception of turnover tax, where tax is on turnover. The relevant tax rate is on a sliding scale. This means that, where someone earns more money, they pay a larger percentage of their income to SARS. Picture it as filling up a glass within a bucket, within a sink, within a pool, and so on. Money is represented by water. And the first glass represents the lowest tax rate. When you have more water than the glass can hold, it will overflow into the bucket. The bucket represents the higher tax rate. When it flows into the bucket, it doesn't matter whether the bucket is 1/4 full, or almost full. You will be taxed at the applicable rate. This then continues until the water starts filling up the pool. A company does not follow the same route, but rather is taxed at a flat rate of 28% regardless. We will talk about the different ways in which a company can change this, so that they can lower the rate applicable at a later stage. The practical example of this is pay as you earn, also known as pay, YE. We then have dividends withholding tax, which is a 20% tax that is withheld by a regulated intermediary on local dividends, declared and accrued, or received. For example, if you own shares in Company X, and the company shows a large profit, that will mean that its preferential shareholders will receive 50,000 Rand in dividends. The company will deduct 20%, and thereafter you will receive 80% of the total amount, which is 40,000 Rand. We then have capital gains tax. This is found to be very confusing to many, despite it actually being an easy concept. capital gains tax is imposed on the gain made on the disposal, or deemed disposal, of capital assets. So, this means that when you sell an asset and you make a profit, you are taxed on a certain percentage of the profit. The taxable capital gain is incorporated into taxable income, to determine the applicable tax payable. This will be discussed in detail, at a later stage. We then have the unfortunate tax, called donations tax. This is where, despite your good intentions, you are taxed on any amount or asset valued above 100,000 rand. It is therefore defined as the tax imposed on a gratuitous disposal of an asset. Therefore, whether you want to give your brother 150,000 rand, or give your mother a house, you will be subject to donations tax. Next is transfer duty. Those who have bought a house, will be familiar with it. Transfer duty is the tax imposed on a legal transfer of fixed property, which is payable by the purchaser. It is normally included in the costs of transfer for the purchaser. As the saying goes, two things in life are certain. These are death, and taxes. The following applies to both. Our next type of direct tax is estate duty. Estate duty is a tax payable at death, on the transfer of wealth. The deceased estate is liable for the tax on income, and not the heir, or legatee. This means that when someone passes away, all of their assets and liabilities are calculated, and where the value of the said estate is large enough, estate duty will be applied and added as an additional liability. Therefore, estate duty only applies to sufficiently large estates. More about wills and estates at a later stage. Those are all of the direct types of taxes. Next is indirect tax. We first have value-added tax, VAT. We are all very familiar with this type of tax. This is an indirect tax of 0%, or 15% levied on goods and services. It is a pretty simple concept at first, but it does get complicated for the VAT vendor themselves. We then have customs duty, which is the tax on imported goods. And lastly, we have excise duty. Most people know this as sin tax. Excise duty is the tax on alcohol, etc. So that's it for the types of taxes. Last but not least, a few key terms that are used in the South African tax industry. The most common term is pay as you earn, also known as pay, as you earn is merely a means of an employer collecting tax from an employee's remuneration. The pay as you earn collected is a withholding of normal income tax by the employer, who then pays it over to SARS on behalf of the employee. When employees receive their salary, it will be net of income tax. In other words, the tax has already been paid. Another confusing term to taxpayers is gross income. Gross income is needed to calculate how much tax is payable by you, as the taxpayer. It essentially forms the basis of the income tax calculation. It is therefore important to understand what amounts form part of your gross income. As per the Act, gross income is defined as, firstly, the total amount. This amount must be expressed in South African currency. Secondly, it must be in cash, or otherwise. Cash and any benefits that have been received, or that have accrued, must be included in gross income. An example of a benefit would be fringe benefits, received by an employee of a company. Thirdly, it must be received by, or accrued to, or in favor of, such resident. This relates to the timing of the amount, and, in which tax year, an amount must be included in gross income. Fourthly, it excludes capital receipts and accruals. For example, capital receipts are subject to the capital gains tax rules, and are not subject to income tax rules. Lastly, it must specifically include certain amounts. This is an important part of the definition. Often, people stop at step 4, and do not make sure that the amount in question is income in nature and not capital in nature. This provision can make a capital amount part of gross income, and not subject to capital gain tax. It is important to know the above, because the onus is on a taxpayer to prove that an amount can be excluded from gross income. If the taxpayer cannot provide evidence to show that an asset was acquired as a capital asset, the proceeds resulting from the sale of that asset will be included in the taxpayer's gross income, to be taxed as normal income tax, instead of the application of a capital gain tax. The next term is capital. Capital is not defined in the Act. More often than not, it is obvious when an asset is capital and not revenue. But where there is uncertainty, and clarity is required, the courts have relied on the golden rule, the intention of the taxpayer. Therefore, if you buy and sell houses to make a living, the income tax rules will apply to you. Generally, trading stock will form part of someone's gross income. Two very confusing terms are receipt and accrual. Amounts are included in gross income when they have been received by, or accrued to, the taxpayer, whichever happens first. If the amount has been beneficially received, there is a receipt for tax purposes, and there is no need to determine if there has been an accrual. It is only when there is no receipt that one needs to determine whether there has been an accrual. For example, has it accrued to you, or has it become due to you? An amount is accrued when a person is unconditionally entitled to an amount, even if he has not yet physically received the money or benefit. Lastly, I would like to discuss fringe benefits and allowances. A fringe benefit is a value placed on either the use of an asset, payments made by and/or services provided by the employer to, or on behalf of his employees, and, in some instances, anyone connected to the employee at time of employment. A fringe benefit does not necessarily represent an amount received directly by the employee. The value of the fringe benefit that an employee receives from his employer is included as gross income for the employee's income tax calculations. Allowance is a cash amount given by the employer to the employee, which forms part of the employee's income. This is an amount received by the employee to generally spend on business expenses related to his employment. These are allowances such as car allowance and uniform allowance. That's it for today's episode, and I hope that it has helped in some way. Thank you so much for watching. Please stay tuned for further episodes by subscribing to my channel. Don't forget to like. Cheers.